Morning everyone, it's Friday the 15th of April. So maybe you think that this morning report's a little bit late. So what happens is if there's any market moving news that's going to be early doors, I'll probably get this to you, and I definitely will actually get this to you much earlier. In the absence of anything significant and the market's pretty damn not volatile, what I would do is try and add a little bit of educational strategy stuff to the morning report. I won't make it long. I won't bore you. I think this process. What I'm trying to do is plant seeds, right? So I don't get in front of you a lot, but what I'd like to do is be able to plant these seeds that you can come back to me and say, yeah, that was interesting. I like that. I'd like to explore that. So let's move on to what's coming up today. Well, it's not necessarily much today. We've got a prelim University of Michigan sentiment. That could be quite important because it's a prelim. We've also got at the weekend, we've got G20 today. Out of G20, we're probably expecting nothing much that's market moving. What we will have is an OPEC meeting over the weekend. I think that could be quite significant. And I think, to be honest with you, looking at the volatility in the markets today, Treasuries and bonds having, bonds having like a 20-tick range, 10-year Treasury having, no more than a 5-tick range in the 10-year note. That's just, I think that's the market sort of waiting to see what happens in OPEC. See, there's a lot of waiting to see. I was talking about it yesterday. Looking at last night's China data, looking at the glass half full, we didn't see a fall below 6.5%, and we didn't see a miss of estimates. You got to remember, the market is global economies are hoping that, and know that China's slowing down, but what they're trying to do, or what they're hoping, is that slowdown is very, very soft, no hard landing, right? So that's it from a data perspective. So here's the sort of educational stuff. So as I promised, Rob, he was very insistent that I talk a lot about US Treasuries and Eurodollars. So here we're going to talk about bringing in Euribor and sterling more. I still want to talk about Eurodollars. I think it's really important, and Treasuries, because the European markets are only open relatively short compared to the US markets, and I think given the correlations, given the way that the global markets are connected, it's very important to know what's going on in the US markets. Right, so what we've got here is, this is kind of how I look at my charts, right? You can replicate these in Stellar, so there's no difference what you can do. This is just in CQG. You can open this up on the Office CQG. So what I've got here are 3 flies, different parts of the curve. I've got the Eurodollar, 4, 5, 6, so the 4th, the 5th, the 6th butterfly. And just to let you know, when I'm talking about a butterfly, you're talking about 2 calendar spreads, one overlaying the other. So your actual position would be +1, -2, +1. Then I've got the LL, 4, 5, 6 fly, 8, 9, 10 fly, and 12, 13, 14 fly, and the Euribor, right? So I will look at all 3 of those markets. Now, as I said yesterday, that the Eurodollars and LL have traditionally been connected to one another in terms of their direction from an economic standpoint. European markets have always had, ever since I've been around, have always lagged more than sterling to the US markets, right? So this is how I look at the market. I mean, on the face of it, these all look, there's not much direction. They're butterflies. So I think what we need to do is I just wanted to show you some analysis. People who don't believe when I'm talking about how the sterling and Euribor can be, following the US markets, and then we can break it down into the components of those flies, because I think flies can be a little bit misleading. So what I've done here, I've overlaid the 4th, 5th, 6th fly. I've made it into a scatter plot. So I'm looking at the Eurodollar to the Euribor here. I'm looking at the Euribor to LL and LL to ED. I mean, what I can see straight away is interestingly because the components of the Euribor, because this is basically telling me that in this instance here, so the LL 456 fly, so the generic 4th, 5th, 6th fly, is actually positively, it's 69% positively correlated to the Eurodollar curve, right? That is in line with what we saw in the front M6, June 6, June 17. We saw a correlation. Now, interestingly, despite we saw a correlation between the June 6, June 17 Euribor and the June 6, June 17 Eurodollar calendar spread, the 456, the 4th, the 5th, the 6th Euribor fly to the Eurodollar is actually inversely correlated. So I think we can explore that a little bit later. And what you can also see is the Euribor 456 fly is inversely correlated to the LL, to the short sterling's fly. So that's an anomaly. As far as I'm concerned, that's an anomaly compared to the structure of the actual curve itself. So June 6, June 7 was positively correlated between Eurodollars, Euribor and short sterling. However, the butterfly of the 456 in Euribor to Eurodollars is inversely correlated, and in Euribor to short sterling is inversely correlated. I think that's an anomaly. I think that's a short-term anomaly. Easy for me to say. Right. So what I do is sometimes calendars can be a little bit noisy, right? So I think to get the better feel is looking at the actual curve shape itself. So if I was looking at the 4th, 5th, 6th fly, what I'm just going to look at is that 6-month calendar spread. So what I've got here is how I start to piece together indicators, right? So you know I talk about Eurodollars and what I look at, but I'll just reconfirm. What I've got here is Eurodollars, Euribor and short sterling. So here I've got the Eurodollars 4th to 6th calendar spread, the generic, always the 4th to 6th contract to the 6th contract. And then I've correlated that, or I've got a chart next to it of the 2s, 5s in a daily perspective, 2s, 5s Treasury spread as a spread. And then I've got 2-year, 4-year US dollar IRS as a spread. Similar for Euribor and sterling. I've got the 4-6 calendar spread for Euribor, 4-6 LL spread. And then I've got the chart right next to it, Schatz bubble, as a correlation of the, or give me an indicator, a strong indicator of where the Euribor 4-6 calendar spread's going. And of course the 2-year to 4-year euro interest rate swap spread. Similarly, what I've got here is the LL 4 to 6 calendar spread. Next to it, I've got the gilts 2s, 5s future spread. Now, 2s, 5s, the 2-year short or short gilt is not very liquid, right? However, by virtue of the fact that the GEM, the gilt edge market makers, are looking at these spreads and can trade on them if they go out of line. Generally speaking, the mid price of the bid ask is bang on where that 2 years should be trading, right? So even though it doesn't trade much, it can give you a lot of price discovery from the mid price. So this is the mid price of the short gilt versus the mid price of the gilt, right? And then here I've got the 2-year, 4-year interest rate swap spread. Now, what I've got here, if you still don't believe me that the front end of the curve or these Eurodollar curves, short sterling curves and Euribor curves are correlated to the bond curves and interest rate swap curves, here is further proof, right? So what I'm trying to do is layer in this information so you start to get a better feel of what I'm talking about. So on this, what I've got is the 4th to 6th Euribor calendar spread, and I've overlaid that or scatter plotted it with Schatz bubble. As you can see very clearly that as the Schatz bubble spread, which is on the horizontal, goes from this 148.20 up to 149.60, there's a strong positive correlation. And as you can see, your 4th to 6th. Remember, that's always the 4th to the 6th, and there's a reason I do that. it's because as contracts roll down the curve, as one expires, they start to trade differently, right? So as you can see, and here I worked out, there's a 95% correlation between that 4th to 6th generic calendar spread currently and the Schatz bubble spread, and a 93% spread of that Euribor, same Euribor spread, versus the 2-year, 4-year interest rate swap spread. Now, what does that tell you? That there's a lot of you say to me, well, that's a lot of theory. Well, actually, what it can tell you is it gives you ranges, right? So it can give you, it can give you a leading indicator to tell you if you're legging into a combination. It can actually give you that leading indicator to say, right, I think I can see Schatz bubbles going up, but my 4th to 6th calendar spread hasn't gone up yet. So I'm definitely going to join the bid. And probably I want to buy it as it turns, because I know that these are highly correlated products. You could also, those you a little bit more technical in your approach, you could plot out, okay, if Schatz bubble, if you follow my mouse, if Schatz bubble is trading 149.30, then all of a sudden, after something opens up at 149.50 or 60, I'm going to expect my calendar spread to be trading from this level here up to this level, right? So that's going to give you an advantage over people who don't know. They know that they can follow the Bund, but they don't know where that range should be trading. You could also look at this 2-year, 4-year interest rate swap, but you don't need to. You can look at it on CQG, but that won't be on your desk. But what you've got, all the price discovery you need in this Schatz bubble. So I think this can be a really important way to trade. What I've also done is done the same for the 4th to 6th short sterling spread versus the short gilt, i.e. your 2s, 5s spread. Now, if you don't believe me about correlations, or you think, well, there are no correlations, just look at how correlated these spreads are. So as you see, highly positively correlated, 92% correlation between the direction of the LL 4th to 6th calendar spread and the short gilt spread, right? So where this is really helpful, it can help you plot whether something's overshot. It can help you plot to take out a spread, to put on a combination, to give you that lead time. Everything's not just about the values and using min vols to buy spreads, right? Sometimes the edge is buying the offer. Sometimes the edge is waiting to be given the bid, right? So they're the subtle differences, all about execution. It's all about those little differences that can impact your trading. And then here, there is a difference why the 2-year, 4-year sterling interest rate swap spread is more correlated, 99% correlated to the direction of your 4th to 6th LL. Why? It's because obviously the LL, the short sterling, is the guys that are trading the sterling interest rate swaps. It settles on LIBOR. Obviously, short sterling settles on LIBOR, so it's much the same product and part of the same yield curve, and it's not even got a difference in its credit quality, right? It's the same credit quality. What you can see again, or what you can actually do again, much like the Euribor spreads, you can look at the ranges. Now, if Monday's quiet, nothing happens on OPEC, I'll talk more about how to plot some ranges in each of these spreads intraday that can help you trade, right? So that's that. Let's just flip back to the screen. What I've got here is the 2-year US TED. The Treasuries have tickled up today, so it's kind of trading over above this 80 level. You see here where my mouse is, 88.5, and we've had a little bit of a pullback in this 5-year TED. I remember I said that all the while Treasuries are trading lower, I'm looking to buy the euro dollar to the 5-year TED, and all the while, all this week, that seems to have worked. I won't be abandoning that thought. unless we see a big rally in the Treasuries. And hopefully you've got enough in the trade that you're going to be able to get out safely and still make some money being long. Okay, so what's happening in the US curve? What we got here, it's very, very flat, very, very boring, right? The Treasury curve, so the 2s, 5s Treasury curve, that's down. And again, why am I telling you this? Because your Euribor spreads, your Euribor spreads and Schatz bubble, your short sterling spreads and your 2s, 5s gilt, they follow these markets. So again, yeah, the report's late. 2s, 5s US curve down 3/4, so that's down flatter. You would expect that in a small pickup in the Treasuries. You've got 5 years, 10-year note spread, that's down 1. You've got the 10-year note to ultra 10-year note, which is really 7-year to 10-year, that's flatter, down 1, down half. And you've got the 10-year note to 30, and that's down 2.5, down 2. Now, interestingly, if I look at the PAC spreads in Eurodollar, there's a slight anomaly here, right? So I got it right that time, where you've got the Treasury spreads, they're flatter. But what you've got is the Eurodollar spreads, they're not flatter. So what if I'm looking here, you've got down the bottom here where my mouse is, this is the reds, greens PAC spread. That's slightly down, right? I still think that should be trading down half, down 3/4, where the Treasury spread's showing me. Up here on the top left, you got the reds to greens. That's even offered down 1/4. I think that should be 1/4 tick lower. Again, you've got the greens to blues, even offer. Now you've got the blues to gold, sorry, and you've got here. So I'm going to play. I think that these spreads should be lower, right? So I've placed sell orders here. So what I'm going to do is why I'm placing these sell orders here in this greens to in this golds to purples PAC spread. I think you've got 10s, 30s lower. You've got 10s, really the 7-year, 10-year spread lower. You've got the 5s, 10s lower. So I think this is a sell, right? I think once the US market comes in, they're going to sell this, right? So I'm working an offer, hoping that someone can come in and cross my bid ask. Let's see how that works out. Good luck, and any questions, let me know.